So investors may want to pull the plug on the big tech trade. Our next guest says the bubble in the sector will start deflating again in Q2. Dan Suzuki is the Deputy Chief Investment Officer at Richard Bernstein Advisors. The firm made its tech bubble call almost 2 years ago. Dan, then it popped and you guys were looking smart. And now, what do you think is happening?
Not so smart anymore? Yeah, I think this is to be expected. I mean, if you go back to the last tech bubble we had, you had 16 different double-digit rallies over that 2.5-year period while the NASDAQ was falling over 80%. This is to be expected. People don't give up the stuff that they've known to come and love that dominates their portfolios, where you're sitting on tons of capital gains still. So I think they're going to fight that. And I think Tim said this, the fact that people want to just go back and own the stuff that's worked over the last cycle tells you a lot about where sentiment is. People don't want to go where the future leadership is going to be, which is not where the bubble is. That bubble is still deflating. And
when you say bubble, you're putting the mega caps in there too? NVIDIA, Microsoft,
absolutely.
Apple, all the leaders.
Yeah, I'd say if the leadership of the last 10 years was really driven by U.S. large cap growth, U.S. mega cap growth, however you want to define it, innovation, technology, all that stuff is still, includes the mega caps for sure.
So if that's the old where you wanted to be, what's the new where you want to be? Where's the puck going?
Yeah, well, if we're right and there is a bubble that's still deflating, I mean, if you just think about what a bubble is, it's a giant vacuum for capital. So you get this massive misallocation of capital into one area of the market. So where's the big opportunity? Where capital is scarce, which is pretty much everything else. If you take out those three sectors in the U.S. that are dominated by technology, I think everything is fair game. Probably not defensives, probably aren't going to be the leadership of the next cycle, but everything else. So that's international, that's small cap, that's value, that's pro-inflation assets. No one wants to own that stuff because it's underperformed for a decade or two. That's why it's so cheap, and that's where the opportunity is.
I think you've got a story to tell around rates peaking, the dollar possibly peaking. So are there places for investors to chase? Chase is maybe the wrong word. I'm actually saying invest in companies that are generating free cash flow, that are growing their payout ratios in an environment where I don't see how the dollar can move significantly higher. I'd argue that's an 11-year bull market in the dollar. Rates, I don't think, can go a lot higher. I mean, this is a backdrop for some companies to perform.
Yeah, absolutely, Tim. I think you're right here. You really have to separate the next 5 to 10 days, next 5 to 10 months, next 5 to 10 years. The next 5 to 10 days, I mean, what's working is probably going to continue to work. I mean, there's probably some room for, a rally and this stuff that's beaten down. 5 to 10 months, I think the key story is that growth is slowing. Profit, we're going to go into earnings season. This earnings season is probably going to be worse than last earnings season. So the companies that are most sensitive to that slowing growth, they're going to probably get hurt by that at some point. But next 5 to 10 years, that's the stuff I was talking about, where the big opportunity is for the long term. So it depends on what your time horizon. It's very different what you want to own. And I think along the way, there's attractive companies that are going to benefit from each one of those dynamics.
Dan, for a lot of these tech companies, credit's the lifeblood of what they do. And I've said it, I don't know, I'm not saying I'm right, but rates could go back to zero. But bank credit lending is going to be tighter than it was before, regardless of where interest rates are. Yeah. How does that play into the tech story?
Yeah, it's huge. I mean, if you think about the area of the market that was the biggest beneficiary of record liquidity, it's those stocks that you're talking about. So as that liquidity goes away, and I agree, if the reason that rates go to zero is because growth is falling off a cliff, then at that point, where's the liquidity going to be? It's not going to be there, right? So I 100% agree, and there are going to be the companies that not only get hit on the liquidity side, but get hit on the earnings side. People think that they're impervious to slowing growth. Look at what their earnings growth is now, and we haven't even really seen the major slowdown in the economy yet. So I think people always underestimate the cyclicality of tech, especially post-pandemic, and I think they'll be surprised again.